Welcome, good afternoon subscribers. So today I'm going to be starting a new little playlist which is in effect quite similar to Martin's money saving supermarket, but this is Geekonomics money saving hints and tips. So the reason that I've started this today is because in recent weeks the year 12 students, we've been looking at the whole notion of interest rates and inflation rates, and the relationship between what you can currently earn in your savings account relative to the current CPI rate of inflation, which, as you well know, is 2.9%. Now, it's been well documented in recent weeks that people who are savers, people who are relying on their savings for a steady stream of income, pensioners in particular, are complaining and feeling a little bit upset at the fact that their savings accounts, which on average in the UK only pay 0.4% interest, when inflation is currently sitting at 2.9%, that is particularly problematic. And we're going to have a look at why that's the case. And then I'm going to recommend to you 5 ways, ladies and gentlemen, 5 money-saving tips from Geeko in which you can help to alleviate this downward spiral, this downward push on the real value of your savings. So, we are currently into the 100th month of low interest rates. Now, by low interest rates, ladies and gentlemen, we mean since the financial crash of 2007-2008, when the interest rate shot down from about 5.25% to 0.5%, for it sat for several years, and of course only last year, as a result of the Brexit vote, did it then reduce once again by quarter point to 0.25%. So currently the base rate is 0.25%, and of course the retail banks, the high street banks, will all be setting their stalls out with regard to the interest rates that they're offering us, the consumer, the saver, on our savings. It all stems from what the base rate is. So savings are struggling to earn a return which beats that current inflation of 2.9%. Now you know that the target for inflation, as was so eloquently described to us yesterday when Deputy Governor Sir John Cunliffe was here at college, the target for inflation is 2%. So it's almost 1 whole percentage point above the target rate, the MPC's target rate for inflation. Now, in the, was it the A-level macro, I believe it was, the first question said to the candidates, can you please calculate the real interest rate? Now, the equation for calculating the real interest rate is the nominal rate, so that's the rate really which is offered by your high street retail bank, the big ad that you'll see in the window, the big advert that you'll see on the website, minus the inflation rate. Now, if we take the average return on an easy access account, so by easy access we mean your money's there and as soon as you want it you can just go and lift it, no problemo. So the average return on those accounts in the UK at the moment is sitting around about 0.4%, absolutely dire, just above zero. And inflation CPI is 2.9%. So that means that in effect you're getting a real interest rate of 0.4 minus 2.9, which is minus 2.5%, so a negative return on your savings. Now, the reason that you're getting a negative return on your savings is because the cost of living, as measured by CPI, is rising much faster than the savings rate which is being offered by your high street bank. Now, it's not all doom and gloom, ladies and gentlemen, and if you shop around and if you follow Geeko's money saving tips, hopefully you will be able to at least alleviate and stem some of this negative rate of return on your savings. So we're going to work through a few here, and they range really from the least risky to the most risky. And obviously, as you would expect, with risk comes reward. So generally speaking, the more risk you take, the likelihood of you getting a significant return is greater. But of course, on the flip side, the likelihood that you might lose everything, there's also that potential when we come to these very highly risky types of investments. So number one here we have, number one solution, regular savings accounts. Put your money into an account which provides you with the facility to save, generally speaking, is between £200 and £250 per month. If you can afford to stash that away somewhere, then you can expect to see a return on that of around about 3.5% per annum. Now 3.5% was of course a little bit higher than the 2.9% in terms of inflation. That would yield you a positive rate of return, because that would be 3.5 minus 2.9, give you a positive 0.6% return. If you are money bags and you do have plenty of cash to be investing, just remember that it's best to spread your risks. So if you have a significant sum of money, and we're talking here above £85,000, got more than £85,000 to save, make sure that you spread your savings around the financial institutions on the high street. Some in the Halifax, some in Lloyds, etc., etc. Because if one of those banks, God forbid, goes bust once again, or nearly bust, well, the Financial Compensation Scheme programme guarantees, of course, up to £85,000 of that for just a single person's account. If you have a joint account, £170,000 is guaranteed. So that's something worth thinking about. And I've just got a little example here. The Nationwide Flexi Direct, that will pay 5% currently on balances up to £2,500. And that's for a 12-month period. I think after the 12 months it flicks back to 1%, but there's something worth looking into. And of course, it's that type of savings account. There's a lot of guarantee there with your money, so it's really, there's not a lot of risk associated with that. So that is my number one inflation busting savings tip. Let's move on. Okay, ladies and gentlemen, let's move on. Now, sometimes it is better to pay down your debts rather than to stash your money into a savings account, which is going to offer you a negative rate of return. I've just got a very simple example here to show you why that is the case. If you had £10,000 of mortgage debt and you were paying sort of the average going rate of interest on that in the UK at the moment, which sits at 2.33%, well, that would mean that over the course of a year, that debt would accumulate £233 of interest. Alternatively, of course, if you had £10,000 to put into the bank at, let's say, a savings rate, will be generous here, 1%, then that would earn you obviously £100. So, in this instance, it would be much better to use that money to pay down to pay off £10,000 of your mortgage debt, because in effect you're paying £233, you're saving yourself £233 of interest payment, and so in effect you're £133 better off in that instance. So paying down your debts is really worth considering in that respect. Thirdly, and now we're getting into the sort of more risky types of things, corporate bonds. These are in effect IOUs which you can purchase from large companies, which when they're seeking to expand, they will issue these bonds to the public, and they then pay you a return obviously for lending them the money. Now in corporate bonds at the moment, the general average is between 4 and 5%. And obviously that's much better than the 0.4% that you could be earning on the Easy Access savings account. Fourthly, as my Year 10 students, Mr. Harry P. was talking about this morning, you could buy shares. Now here's a great example of how your money can grow in the stock market. If you had put £1,000 into the FTSE in 2009, well, today it would be worth £3,077. That same £1,000 invested in 2009 into a simple Easy Access savings account would only be worth £1,013 today. So you can see that there is a very significant benefit from investing your money into stocks and shares. if you didn't feel that you were sufficiently knowledgeable to buy and to identify your own stocks and shares, then why not invest in a fund? Invest in a management fund whereby somebody will be looking at a whole portfolio of shares on your behalf, and then they can do the groundwork for you. Now the return will not be as high, but you're still going to be earning significantly more than you would if you simply put your money into savings. And then finally, and probably the most risky of these 5, would be to lend to growing companies via a peer-to-peer sort of lending service. So some of these you might have heard of before, such as Funding Circle or RateSetter. These are financial intermediaries whereby your money can be lent to growing companies, and again they tend to return about 4 to 5%. Now again, they're riskier than obviously putting your money into a regular savings account, but the return is greater. So those, ladies and gentlemen, are GECO's 5 ways in which you can protect your savings from the very detrimental and negative effects of inflation. Bye for now.